Welcome to Coin Toss. I'm your guest host, Nolan Bauerle, and this might be the best coin toss you've ever participated in because we're going to be talking about the bridge between Wall Street valuations and what the heck's going on with all these animal coins and meme coins and everything else in crypto. So we're right in the middle of what everyone's talking about these days. So the subject really is about valuations and our first guest, how they're calculated. Our first guest, David Trainor, is CEO of New Constructs, an independent equity research firm that uses machine learning and natural language processing to parse corporate filings and model economic earnings. And now, what do we do with these valuations? That's what everyone's asking as they're looking at Dogecoin go up, right? How do they work in an era of extreme change? And for that, we've got Paul Brody to guide us. Paul was one of the first people from any large company to look at blockchain technology. I've been reading Paul's stuff since about 2015. I loved the IoT stuff, Paul. That was great, and I can't wait to see the IoT world explode with the adoption here. So Paul, has discussed sort of the implications of Satoshi's invention for a long time now, and is here as the global blockchain lead at Ernst Young, and will help us answer some of these questions around what we're doing with these valuations. So welcome to the discussion, which I've called FOMO Valuations. Are animal coins worse than Wall Street? Here we go. So I do want to start with David, because we are talking about valuations, and you did write that detailed article about a month ago on COINBASE. So I'd like to start, with let us run through the way you perform the valuation and why you arrived at this opinion.
Yeah, the idea is that based on sort of core principles, right, the value of an asset is equal to the present value of future cash flows. And so when the market gives us a price, we can reverse engineer what those future cash flows have to be to calculate that price or justify that price. And when you do that with COINBASE at the $100 billion valuation, you're looking at a business that the market is projecting to be 150% larger than the combined revenues of NASDAQ and the Intercontinental Exchange, while having margins that are 45 times higher. And so effectively, everything good that could possibly happen is mostly, if not entirely, priced in. And you have to also put that in the context of, a competitive world, right? I mean, anytime a business has high margins, it's going to attract competition. Other people can see that there are profits to be had in new technologies. And over again, we see that a lot of money rushes in at the beginning. Right? Nobody even knows, probably remembers what Netscape is, right? One of the original browsers, right? I mean, those guys had a really high valuation and they're not here anymore. So new technologies suck in a lot of capital, oftentimes to initial players who don't end up surviving. And so you got to be careful. I think crypto and blockchain in particular is an amazing technology. That doesn't mean that many companies will be able to sort of become gating forces, right? They're going to make sure that individuals transfer a lot of the value of that technology to them before they receive the benefit of that technology. I think it's hard to make a strong argument that companies will do that, especially with blockchain. I think it's even harder to make a straight-faced argument that a company like COINBASE will be able to be as profitable and as large as expected.
I want to push back a little bit, David, on your assessment of the Netscape connection, because when I looked at this filing, I saw a lot of those people who did not disappear, but in fact were behind COINBASE from the start. Mark Andreessen's note that he wrote in 2012 about Bitcoin was actually a lot more predictive than most Wall Street analysis that came out around Bitcoin at the time. And it was just an article saying, it was the software is eating the world frame, right? So those guys, although Netscape, of course, as a company and as a tool, long gone, but A16Z, which is really the inheritor of that, frame, is still around and was definitely in on this one, big time. And I want to go back, to Paul and just talk a bit about, we heard cash flow, revenues, they've got to be larger than 1.5 times larger than the two largest exchanges in the world, in America. If you were looking as someone who's looking at long-term change management, right? A lot of people said, Coinbase overvalued. And look, David has been right. His prediction from a few weeks ago, now that the coin has, or the stock has been traded, has certainly gone down. But what metrics would you use if you were discussing that type of change management and the impact that such a company like Coinbase can have? Is it apples to apples if you're comparing it to typical exchanges?
Well, it sort of is, right? And I want to just say, wow, I want to violently agree with David's methodology, right? Discounted cash flow is how you should measure these companies. There's nothing wrong with that logic, right? And so I think what is challenging and interesting about this situation is if we go back and look historically at companies that have been successful, if they do come to dominate their space, what tends to happen is that not only do they sustain kind of outsized growth rates, they also sustain outsized market share and outsized margins, right? We are in a software eating the world business, and this is a software business that's built on a network technology, and it's going to have all the characteristics of a software business built on network technology, which means that once you lock in a leadership position, and by the way, look at cloud computing, look at networking software, those are businesses that are dominated by the companies that really push them forward initially. So I would say, the methodology is not necessarily wrong, right? It's kind of hard to predict the size and future, but it's certainly possible that a single company, and I never, ever sort of focus on single companies just because at EY, we don't talk about single companies and their stock valuations, and B, it's just, I went to the sort of random walk down Wall Street school, so I believe in index funds and sort of bigger portfolios. But overall, the principle that you should measure based on discounted cash flows and you should think about good historical comparable analogies, to me, is spot on.
Great. And so the Coinbase, price, the actual coin stock being overvalued, I would say I agree, but my metric was looking at the price of Bitcoin and how much Coinbase at $100 billion would be worth in terms of Bitcoin, right? So I did, $2 billion, $100 million. $100 billion is 1/10 of the $1 trillion market cap of Bitcoin. So that makes it 2 million Bitcoins. And I said, whoa, I'm not paying $2 million Bitcoins for Coinbase, right? And I think even a few folks who put, seed round investments into Coinbase said, if I'd have just kept it in Bitcoin, I wouldn't have made that investment in Bitcoin. I'd have had more money now, right? I'd have come out ahead. But it brings up an important point because we're measuring stuff, discounted cash flows and the valuation of Coinbase in dollars, right? We're measuring these things in dollars. So this question is for you, David. Earnings week came last week, and we heard a lot about inflation and the value of those dollars. We heard a lot about de-risking and everything that's going on there. So if you wouldn't mind talking a little bit about how useful these measurements are right now with inflation looming in the air.
I think the corporate earnings has long been the object of a lot of concern with respect to manipulation. Study after study has shown that both the companies and the Wall Street analysts themselves manipulate these numbers in order to get those beats that tend to drive the stock up. And we've also seen an explosion in disclosures. We talk about software eating the world. And by the way, I agree with everything that Paul says too. I do think that there are, in a few occasions in revolutionary technologies, opportunities for certain companies to maintain outsized market share. And plenty of examples, Amazon, Facebook, et cetera. And it's the same with networking, cloud computing, right? I think in the case of Coinbase, a lot of that's priced in. I think in the case of earnings in general, we live in a world where most investors don't have the time to actually do the analysis they need to understand profitability, right? The software is eating the world, and so is paper in a lot of ways, right? The average quarterly report is 250 pages. There are thousands, hundreds of disclosures that are required reading if you really want to understand profits. And I think what we've seen in the meme stock and in many cases the cryptocurrency era is people just throwing their hands up saying, that's too much work. I'm not doing that. To heck with you guys. You're making it too hard for me. So I'm going to make these stocks go up for no fundamental reason whatsoever. And if you're short them, to heck with you, right? You've been putting it to me for the last 15, 20 years. I'm putting it to you. Fundamentals aren't going to matter. And I think that's a very valid concern. And I think a lot of individual investors have a right to be upset that they haven't been given access to reliable fundamental research. And for that reason, we don't put a lot of stock in reported earnings and analyst earnings. Instead, we lean on more rigorous approaches. And a lot of those approaches have been meaningfully, supported and even proven by some recent academic research showing that the numbers that you get from traditional research firms and from Wall Street are off about 20% for 20% of companies. So that's how I feel about it.
Sure. But let's take a minute again and compare ICE and CME to Coinbase in this case. We saw the wallet, for example, and I agree. We can argue a little bit about what you said about these numbers being juiced because it said something like 40 million wallets had been associated with Coinbase or 30 million or something like that. And I mean, I personally probably represent maybe 5 or 6 of those just because we open wallets and we don't think of them as bank accounts, of course, the same way we would. And you burn them and you start another one for another reason and you forgot about one, so you start another. So Paul, definitely we can see that these metrics are on a different scale, right? The users of Coinbase are much greater than the users of traditional exchanges just because they're limited access to accredited investors and various other counterparties. So what I want to talk about now is, certainly we can juice some of those numbers, but when you look at the base of people that can access these technologies, the democratization, we hear it a lot, the democratization of Wall Street coming from a lot of these folks. How do you frame those numbers? And do you see the potential, because of this completely new user base or client base than we've seen in markets before, can that actually make some of these numbers, the 1.5, the combined discounted cash flow of ICE and CME possible?
So again, without sort of trying to drill into the specific numbers, I would say what we do know is somewhere between 8 and 10% of the US population owns crypto assets. And over the last year or two, the number of people who have access to buy them, not just through Coinbase, but through PayPal and Square and all of these other companies that are making it consumer accessible, that number is starting to grow enormously. And we see in the data that's publicly reported across the board, huge increases. My own prediction, which I've been on the record previously, is that over the course of this year, a couple of things are going to happen. First of all, access to just plain old Bitcoin and Ether is going to become commoditized. No matter who you bank with, whether it's a consumer application or a traditional bank, you'll be able to buy Bitcoin and Ether alongside all of your traditional assets. And what that's going to do, though, is I think is it's probably going to whet people's appetite for more sophisticated and useful assets. They're going to want to go into DeFi. And when they do, when they want to start accessing that, they're going to look for providers who can do a broader range. So not only do I think we will see the first big banks and exchanges offering direct-to-consumer kind of curated offerings of DeFi, but the volume of users and transactions and value that's being kind of managed and passing through these exchanges is likely to kind of really grow enormously. And so it might not be right to compare. The other question you might ask is, are we comparing them just to exchanges, or should we be comparing some of these crypto asset exchanges to some combination of investment and consumer banking as well? And would the valuations be different in those cases? I don't disagree with David, the fundamentals concept. I just think we got to slice out, like, what are we comparing them to? Because it's not always an apples to apples.
And that's what I'm trying to drill down to, David. You've got Coinbase, which has this, unbelievable composability on the platform. If you compare it to ICE, for example, there's more stuff for more people to do, right? There's just more stuff to do. You could stake. Soon you'll be able to launch a coin. They've got, and then with the DeFi wallet, that's the ultimate in composability, right? They've got a stable coin mixed in. So they're privately issuing their own dollars like a free bank would, years ago. So you've got a certain range of composability. You've got a certain now range of strategies that can be deployed by these folks, much greater than what can happen on some of the traditional exchange. Do you see that as, how would you factor that into valuations? How would you find a way to account for that type of difference?
I think Paul makes a great point. I think this comes back to the larger issue or larger really concept here about blockchain being a revolutionary technology for the benefit of society. It's designed to transmit as much of that value to society as possible. And a lot of these activities we're talking about that would be additional offerings and unique things on COINBASE that you wouldn't do in a traditional exchange. Well, you might do sort of in a traditional bank, right? So what we're talking about here are applications built on blockchain that certain companies will own and therefore try to extract value for. My bigger point on all this is that I don't think that the corporations, and I don't think it was the intent of blockchain, I don't think the corporations are going to be able to extract that much value from the blockchain benefit to society. Most of that will transmit to consumers. And most of what these activities you're talking about are not that unique, except that they're built on the blockchain technology, which means the switching costs from one provider to the other could be really low, right? Just as you've had 4 or 5 wallets, you burn one, pick up another. That means that that's going to be very difficult for any one corporate entity to earn some lion's share of profits from that activity. And so I think that means that consumers ultimately are going to benefit more than a particular company. Sure, Coinbase can have a plethora of services related to crypto. So could JP Morgan. So could Bank of America. So could New York Stock Exchange. And by the way, all of those businesses bring an enormous amount of infrastructure and distribution that Coinbase doesn't yet have. Coinbase is sort of a one-trick pony on the crypto side. These other firms already have these relationships, all these other kind of customers and connections with customers that are valuable, to which crypto could be added. So I think it's not so much that there isn't a lot of value to come from Coinbase and from crypto. There are a lot of very large, capable firms competing for a share of the profits from the delivery of that value. And I believe a lot of that competition will lead to ultimately very low margins so that most of the value of blockchain transmits to the consumer, which is the intent of blockchain, I believe, philosophically from the beginning, and really the intent of this whole decentralization movement. It's not an indictment on crypto or blockchain that Coinbase is overvalued, right? It's an endorsement of the competitive nature of American society that people are going to try to deliver the best product possible to the individuals at the best possible price. That just means there's not a lot of money for corporations to be made as middlemen.
Got it.
I really hope that we have this level of kind of value creation that goes direct to consumers. I will say, if you've ever tried to move your kind of crypto assets from one exchange to another, it's not actually really any easier than moving it from one bank to another. And I personally don't believe that most people want to be their own bank. It's too complicated, it's too difficult, it's too risky. So I think, while I agree that most of the value is likely to go to end consumers, it's possible that there could be 1 or 2 pockets in this business where enterprises have the ability to make an outside share of revenue and an outsized growth opportunity. This might be one, in the same way that we're very dependent on our ISPs. And even though many parts of the internet are extremely competitive, certain things like ISP, network access, is remarkably, in many parts of the world, uncompetitive. And the US is a really good example. We're all very unhappy with our internet access options. And it's certainly possible that a few years down the road, we might discover that there's remarkable level of inertia in your consumer banking or consumer crypto asset exchange relationships.
Yeah, we think of just the ability to let's say you get your stimulus checks, it's sort of training folks now to do something else with their liquidity, right? They're not just giving it to a bank for a long-term loan for a house. They are chasing all kinds of what we can call lottery tickets, a lot of lottery tickets on Coinbase and things like that. But it does, nevertheless. And
some of that's not going to end. That's not going to have a happy ending. A lot of that is not going to have a happy ending. And the question is, will the enthusiasm for blockchain and consumer investors survive what may not be a happy ending for some of these things?
Sure. But let's talk about the psychology of it, right? Because you do have an increased risk appetite, and they want the happy ending, but there is this risk of the not happy ending, right? But let's put it down to fundamentals again, right? With all the printing of money that's gone on over the last year, almost all fundamental analysis that was created in February 2020 and before can almost be thrown out now, right? It's almost not useless because the denominator changed, right? The denominator changed in a lot of that. Now, when I look at a lot of crypto research, especially around Bitcoin, some of the models, stock to flow, for example, right? That stuff was produced in 2015, 2016, 2017, 2018, 2019. People talked about it the whole time. This has been more predictive, right? It's been more accurate, right? It had a better idea of what the future was going to look like than all of Wall Street did in just February 2020. So because it's predicted this more accurate vision of the future, right? Is there not some way to imagine that crypto can actually help manage risk and change? David, I ask you this because if we did use all of those typical valuations, we might not see the forest for the trees. We might not see the stuff that Paul is referring to, fundamental generational change, come up in the numbers, whereas stock to flow around Bitcoin tells us the future so far.
I don't know that the two need to be mutually exclusive. Look, having been a veteran of Wall Street for a long time, it's in the best interest of these bankers to drum up a lot of interest in these securities, and they make a lot of money as toll takers along the way. I don't think that a more reasoned approach to valuation would affect stock to flow and the other research that you're referring to about how these new technologies will emerge and be successful. I think everyone loves that. I love that. I think these technologies are what make the world a better place and are important to the improvement of civilization over time. That doesn't mean we shouldn't be discerning about how we bet on which ones are going to win, right? And really our message is to say, hey, let's just be careful that, if one of these securities comes out at a valuation that already is pricing in that it will be the winner, maybe it's a little too expensive. Maybe you want to look further upstream into some more pick and shovel type of blockchain technologies that have not received the Wall Street spotlight and garnered incredible valuations. Look for stuff that's a little bit better deal. But it's not a bet against the technology. And it's not to say that research about how technologies are going to change the world are no good. It's more to say that investors should be discerning about where they place their bets and understand that the people selling the bets are in the business of making money on the bets, not necessarily making money on the securities they're selling. So it's a buyer beware message more than anything else, a discernment message more than anything else.
Got it. And Paul, when you see the buyer beware message, and you also see ideas spreading through memes, for example, right? The memes are incredibly viral and really powerful and are moving markets like we've never seen. How does this fundamental research fight the persuasion game? Let's say fight the persuasion game. Is it going to take blood? Is that what it's going to require, right? Are people going to have to lose to understand that they have to go back to the fundamentals? Or is there a way through the memes, right, through innovation that we don't see coming in order to maybe make this transition a little easier on folks?
So the memes are really fun. And I feel like I'm going to sound like an old crank, but they're not really based on any kind of fundamentals. So I fear that a lot of the memes are just going to have an unhappy ending, right? And when you look in some of the online forums, if you have any critical thoughts, right, you tend to get attacked pretty viciously. Man, you have pushed things far when Twitter says you have 200 replies and they only want to show you like 50 of them, right? And the rest are full of obscenities. So, it gets pretty intense online in that space. Where I would say that I disagree with a lot of the folks who talk about kind of Bitcoin and the assets and the valuations of these companies is they tend to focus on the currency. They focus on Bitcoin or Ether or Dogecoin or Litecoin or any of these others. And the analogy that I would like to draw is let's go back in time and let's think about, the US dollar and the US economy. So I think back in 1916, the US economy surpassed the UK economy, right? And in a way you could think of like Ethereum, as an economic ecosystem. And if we go back in time and we say, geez, should you have bought dollars in 1916? The answer is yes. If you had traded your British pounds for American dollars in 1916, it would have been a okay investment, relatively speaking, but not that good, right? So today, I think back in 1916, you needed about $4 or $5 to buy one British pound, and today you need about 1.5 or 1 3/4. So yes, the dollar has appreciated in value relative to these other currencies. But if you wanted to make real money, the smart thing would have been to go back in time and buy a cross-section of U.S. stocks, the companies that do transactions in this economic ecosystem. Ethereum in particular is creating a new digital asset-based economic ecosystem. And the question people ought to be asking is, am I just buying the dollar, right? Or its sort of Ethereum equivalent, which is Ether? Or am I buying into the companies, the entities that are going to make that ecosystem successful? Do I just want to buy dollars, or do I want to use those dollars to buy the S&P 500 index or its equivalent in the Ethereum blockchain? And here I think is also, by the way, where the Ethereum ecosystem, which is really starting to look like a kind of rich and mature and rapidly developing economy, looks different from the Bitcoin ecosystem, which is very focused on kind of the scarcity value of Bitcoin and its use as a payment mechanism. And the sucking sound that you hear is Ethereum sucking in all these assets, so even including Bitcoin, which people are wrapping and putting into the Ethereum ecosystem. So I think people ought to ask themselves, okay, if we really are creating this whole new digital ecosystem that's going to create enormous amounts of value, how would I go about investing in that? And it's probably not just to buy the digital currency.
So running out of time here, but David, it'll be last word to you. Would you mind responding to that? And basically what you're looking at, if you are looking at some new metrics in order to let's say, navigate that change within the cryptocurrency world, are there particular data points you're looking at that you think are necessary for some fundamental analysis over there?
I think with Paul's analogy is great, right? And that was what I was getting at when I said, let's focus more on the picks and shovels of the crypto and blockchain movement than the glamour stocks that Wall Street's looking to sell. I would look further upstream to things that have not been brought to as much attention because I agree, right? There is a new digital infrastructure that's coming to the world, and it makes sense. It's more efficient. But don't necessarily sell what Wall Street's or buy what Wall Street's trying to sell. And I think when it comes to understanding stocks and understanding profits, I think it's important to look at true core earnings. Those are difficult to find, but it's available in the marketplace. And then I would, and, you know, not to pat myself in the back here, but I would endorse this expectations quantification approach to valuation. Understand what the stock price implies with respect to future cash flows and profits. It's just a fair thing to build into one's investment decision-making process. I'm not here to say that fundamentals should be 100% of your process, but it probably shouldn't be zero. And to the extent you can quantify those expectations, you're just making a more informed decision about one stock versus another. Because to Paul's point, this movement's happening, right? If you could go in and buy all the cheap stocks in the movement, you're going to do a whole lot better than if you buy the super overvalued stocks. And just do the research. And again, fundamentals don't need to be 100% of what you do, but if you can add that layer, it's just making you smarter.
So even if we're talking about generational change in technology, still buy low, sell high. Nothing really has changed.
Why not?
Great. Well, folks, that's all the time we have for CoinDesk this week. Thanks for another great episode. Thanks again both to Paul and David for joining us today. You were great guests. Thanks for trying to join up on this meeting of the minds. You know, fundamental analysis, generational change. I think it was a pretty good mix. So please tune in next week at 10:30 for another episode of CoinToss. Thanks, everyone.